I would like to dedicate this video to Mr. Santosh Kumar Merwade because he sent me this email. I want to respond to this email with this video. So he's saying, "Hello, sir. As I have gone through your YouTube videos, I saw that you used 8 and 21 EMA for short term trends, 50 SMA for mid term trends, and 150 and 200 SMA for long term trends. Why didn't you consider EMA for mid and long term trends as well? Is there any reason behind this?" So let us first address this question. Why not EMA for long term trends and mid term? So basically, he's talking about the moving averages. Let me go to the moving averages. So let's take any stock, say for example, Polycab. Okay, so here you see blue, green, blue, red, green. So red is the 200 SMA, green is the 150 SMA, and blue is the 50 SMA. So he's asking, why are these not EMA? Why are they SMA? Well, the answer is very simple. People like Mark Minervini, William O'Neill, David Ryan, they all did research on leading stocks, and their research was done on close to 100 years worth of stock market data. And they found that 98% of the leading stocks of the past were already in a confirmed stage 2 uptrend before they began their large scale price advance. Let me repeat that 98% of all the leading stocks of the past were already in a confirmed stage 2 uptrend before they even began their large scale price advance. Confirmed stage 2 uptrend means blue, green, red. So, for example, if I go to, let's say, HDFC Asset Management Company. See, this is blue, green, red. The stock is in a confirmed stage 2 uptrend. By the way, quick disclaimer, I am a SEBI-registered research analyst. So please read the disclaimers in the description box. Okay. No investment recommendation, no buy sell recommendation. I don't write research reports. All of my content is for educational purposes only. So if you look at this stock, this is in a confirmed stage 2 uptrend because the blue is above the green, green is above the red. Preferably the slope should be up and preferably the price should be above all the three moving averages. That's the preferred criteria. And people like Mark Minervini, William O'Neill found that 98% of all the leading stocks of the past were already in a confirmed stage 2 uptrend. William O'Neill looked at the weekly charts. He never looked at the daily charts for his research. But Mark Minervini has clearly written in his book the definition of trend template criteria, which where these three moving averages are spoken about. So that is the only reason. There is no specific other reason for not using EMA. It's based on experimental evidence. So as he rightly says in the email, the 150 and 200, these two are representing the long-term trend of the stock. The blue represents the mid-term trend of the stock. And then you have a couple of more. You see the purple line is the 21 EMA and 8 orange line is the 8 EMA. Now 8 and 21, where do they come from? They come from Patrick Walker. Patrick Walker is a veteran trader in the US stock market. He, along with his friend, they tried to find out which moving averages are the best when it comes to management of the trade. So they found out that the 8 EMA is good for those traders who want to quickly book their gains. 20 EMA is better for those traders who want to give the stock some more time. And it was also found that the 21 EMA and 50 SMA can be used for pullback trading as well. So here is a pullback on the 50, then here is a pullback on the 21 EMA. I don't discuss pullbacks because I don't do pullbacks. There is a guy called Charles Harris. He has worked in the William O'Neill company for a long time. So you can just type in YouTube, you can just type Charles Harris and write Richard Moglin from the Trader Lion podcast. You will get the video where he gives a proper presentation on how to do pullback trading when the market is in a confirmed uptrend. So the ATMA is to quickly book gains, maximize your gains before the stock starts to collapse. So ATMA is for management of the trade, especially swing trades. The 21 EMA can be used for managing the trade as well as for pullback trading. The 50 SMA is for positional trading. You could hang in there as long as the stock remains above the 50 SMA and it is fundamentally strong. Pullbacks can also be traded on the 50 SMA as long as the market is in a confirmed uptrend. So every moving average has got a purpose. Every line that you see on the chart has got a purpose. So if I hide these two ribbons, you can't make any sense of the stock. But if you add the lines, you can quickly see like HDFC is a confirmed stage 2 uptrend. You compare this to Polycab. See, green line is below the red. So you can immediately see the difference between HDFC, AMC and Polycab. No recommendations. Okay. I have made the disclaimer already. Don't consider my stock names as recommendations. I am just helping you compare two stocks. What Mark Minervini is saying is that the probability that HDFC asset management company does well is more than the probability that Polycab will do well. Mark Minervini is not saying don't buy Polycab. Mark Minervini is saying you can buy Polycab if you want, but you're unnecessarily incurring that risk. You're choosing to be in that 2% club. You are not choosing to be in that 98% club. 98% of the leading stocks of the past were already in a confirmed stage 2 uptrend before they began their large scale price advance. So you decide whether you want to be in the 98% club or the 2% club. So even I say if you want to buy Polycab in this situation, you could buy, but you're taking unnecessary risk. Same is the case with a red flag. If a stock has a red flag on Market Smith, I am not saying don't buy. I am saying you are incurring additional risk. So if you are able to control that risk by going in with a small position size or taking a test trade, things like that. If you are doing those risk management, taking those risk management measures, I think that is fine. But I, being a conservative investor, I wouldn't bother getting into such stocks. I prefer to stay out of trouble. So, next, one more doubt, sir. As Mark Minervini says in his book, Think and Trade Like a Champion, page number 151, if you were focused on the popular indexes and not the leading stocks, you would surely miss strong stocks opportunity. Then why should we consider market condition? Isn't it we miss some good opportunity? That's a very good question. So basically, he's talking about the market conditions. So as you can see, there are four market conditions: confirmed uptrend, uptrend under pressure, rally attempt, confirmed uptrend, uptrend under pressure, rally attempt, and just a second. Confirmed uptrend, uptrend under pressure, rally attempt, and downtrend. We can take a swing. We have decided that we will take a swing and positional trade on confirmed uptrend. Uptrend under pressure and rally attempt, we will not take any swing trade. We will only take a positional trade. In rally attempt, we will take a smaller position size. Confirmed downtrend, we have decided that we will not neither take swing nor we will take positional. That is our policy, right? As per our orange trading system. Now, what Mark Minervini is saying is that let's say currently the market is in uptrend under pressure. You filter the stock market, you get, let's say, 53 stocks. Yesterday I checked, there were around 53 stocks. Out of 53, I found only one stock which is forming a base and which is fundamentally strong. Okay, so one out of 53. And these 53 stocks came from 5,417 stocks roughly. So you imagine out of 5,417 stocks, I was able to narrow down at one stock which is forming a base and which shows fundamental strength. That's a weak market. Okay. In a strong market, you get a lot of opportunities. However, what Mark Minervini is saying is that let's say you are in a confirmed downtrend, everything is falling, and you have, let's say, 27 stocks on your filtered list. When you filter the market, you get only 27 stocks because the market is in a confirmed downtrend. In such case, if you study those 27 stocks, if you find that four or five out of them are fundamentally strong and they are forming a base, what you can conclude is that those four or five stocks are showing resilience in a confirmed downtrend, right? Because they are not falling as much as the other stocks are falling. So their relative strength is going up because they are not falling with a falling market. So these are four or five stocks with a higher relative strength and showing fundamental strength. In such cases, rather than waiting for the indices to turn up and waiting for the downtrend to become rally attempt and confirmed uptrend, by that time it will be too late. It makes sense to buy these stocks. But you have to be careful. In a confirmed downtrend, if you're getting only one stock, that is not a clear indication of strength in the overall in a small segment of a market in a downtrend. If you are getting multiple cases where four or five good stocks, fundamentally good stocks are forming bases, they are refusing to fall. Imagine if a stock does not fall in a confirmed downtrend, what will it do in a confirmed uptrend? It can give a fantastic return. So that is what Mark Minervini is saying. Before even waiting for this situation to change, you could start taking a position in those stocks. Now the question is position size. What position size should be taken? Since the market is in a confirmed downtrend, obviously we go in either with a test position or a small position size, tight stop loss, because you never know, the market could continue to be in a confirmed downtrend for a long time and you might end up losing money. So Mark Minervini is not saying don't buy stocks in a confirmed downtrend. Even I am not saying don't buy stocks in a confirmed downtrend. All I am saying is that if you buy stocks in a confirmed downtrend, you are incurring additional risk. So if you can find a way to control that risk, you can take a position even in a confirmed downtrend. The only important thing here is you should be aware of the risk. If you get into a trade with the awareness of risk, you will do something to control that risk. If you get into the trade without any awareness of risk, then I have no prayer for you. Okay? That's the idea that Mark Minervini was trying to convey on that page number 51. Although I think there he doesn't talk about the position size while entering such stocks, he also doesn't talk about where exactly to keep the stop loss. In my view, the position size should be small because the market is still in a confirmed downtrend. In my view, the stop loss should be very tight, not some random 5%, 8%. It should be a tight stop loss. So if the stock breaks out during a confirmed downtrend, it could come under pressures at some point in time. So we need to control that risk. Okay. I hope I have answered both the questions by Santosh Kumar Merwade. Gratitude to him for sending me this question. One email I am using to make a positive contribution to other subscribers' trading journey. So that is why I like to discuss emails, because some of you might be having the same question about moving averages and market conditions. I hope this video has been helpful. Thank you so much.